Can I start an infinite banking policy with a large lump of money? That is something we often get asked at McPhee Insurance. And so today we're going to address that question right here on Wealth Talks.
John was at a real estate investors conference last week, and a real estate investor asked him this question.
He said, so what if I had $100,000? Could I put it into infinite banking? And the answer is technically yes, because infinite banking is about managing your money. So any amount of money you have, you can manage with the infinite banking process. Now, in the context of his question, I think he meant, can I put it all into an infinite banking policy? The answer to that question is, it depends.
It does depend. It depends on age. It depends on how much money he's got. He said $100,000. It depends on if that lump sum of money is going to be readily available today or if it's going to trickle in over a period of time. There's a lot of factors that have to be considered so that we design the policy to best fit the needs of the person that's wanting to start the policy.
And something we don't get to know in this question is the $100,000 that he's putting in this year, or that he was thinking about putting in, is he going to have $100,000 again next year for the premium? Or is this something that needs to be able to cover the premiums on an infinite banking policy for a number of years?
I liked what you said just a moment ago, Tom, needs. We're always looking at what are the needs and the goals of our clients. So when they have this lump sum, we have to consider how are we going to help them with their financial goals. And we have today with us several different examples of people that we've helped who've come to us with lump sums.
That's why we always offer free consultations to people so that we can get to know what their needs are, what they're really trying to do, what they understand about infinite banking, and so that they're getting into something that really is going to work for them and not just pay somebody a commission for selling a life insurance policy.
That happens a lot in the industry. And the way that we typically approach a policy design is we'll look at somebody's cash flow and we'll work off of cash flow. We often talk about the 10-20-70 rule, where we take 100% of somebody's income, we divide it up. 70% should be for lifestyle. 10% is the minimum that you want to be saving. That's often a good place to start for a life insurance premium on an annual basis. Some people choose to pay that, break it down even to a monthly basis and pay that, 10% toward a life insurance premium. 20% of someone's cash flow should be for paying off debt. If they have debts like credit cards, personal lines of credit, things like that. If they don't have debts, then maybe some of that can go toward a life insurance premium or toward repaying the policy loans that they take on their policies over the years. So it can be structured different ways. The 10-20-70 rule is often a great place to start cash flow wise. But then we have this situation where people are coming with a lump sum of money, and that changes the picture a little bit. So now we have some more options.
I'm thinking about Ray when you talk about this lump sum of money, because a couple of years ago, Ray approached us and he said, I've got $1 million I want to put in life insurance over 10 years. Well, now that's $1 million that's going into life insurance, but it's not he's not trying to get it all in the first year. And so we began to work with him, and he had talked to several other agents and had lots of different life insurance illustrations that he was showing us. And we were able to put $100,000 a year into a life insurance policy over 10 years, got his $1 million in there, and made it where he had more money in cash value than what he paid for it at the end of 10 years. And that was better than any other insurance company that he was working with could do. One of the reasons that he wanted to do this is he said, I wish I would have done this years ago because I've lost millions of dollars in real estate. And if I would have done this before I invested in real estate, I would still have my money.
That's interesting because so many people with an investment mindset, they're always thinking of how can they maximize their rate of return. Infinite banking is about improving your returns over a long period of time, but it gives you a foundation to start from. So you don't have to feel pressured to always go out and find that next rate of return. Because regardless of the type of investment, and real estate investments especially, you're not always going to have your money at work. There's going to be periods of downtime. So what is your money doing during those times? Infinite banking makes sure that your money is always at work and gives you that foundation.
Well, something that Ray understood and made us very comfortable with selling this policy is that he realized that even if he borrowed the money from this policy and invested it and the investment went south, he was not going to lose the growth on the money that he put into the policy because that was going to compound forever. Now, he would have to pay interest on any loans he had to take out, but that's what he meant when he said, I wouldn't have lost my money if I'd have done this first. And that's really important because it's the return of our money that is almost more critical than the rate of return that we earn on our money. Because if we lose our money, we don't earn any rate of return and we have to go back and work for it again.
So this structure for race policy is very similar to a regular policy where a premium is paid every year. And in this particular case, you stopped all premiums after 10 years because, $100,000 for 10 years, that's that $1 million that he was looking at. Our next example, we want to go to a different structure, what's called a single premium policy. This isn't a typical design we normally go to for infinite banking, but it works.
It does work. And Nelson Nash, the founder of Infinite Banking and the concept of becoming your own banker, said, these policies are a modified endowment contract. But that's not the end of the world. You just have to understand how they work, and the taxes are going to be a little bit different. And so this really depends on the age of a client, whether we would even consider a modified endowment single premium policy, because when you access money out of a single premium policy, then it's treated as money that was in a 401k or an IRA for tax purposes. So if you're not 59 and a half, a modified endowment single premium policy is not something that we're probably going to consider with you because we don't want you to have to pay a 25 or 10% penalty just to access your cash value. Now, at the same time, if you're over 59 and a half and you've got a lump sum, it's a great way to create a bigger legacy than just the $100,000 this Sherry that came to us said, I would like to put this in a single premium policy did, because now her death benefit with $100,000 jumps up to, $191,000 immediately and keeps growing for the rest of her life. And so that is a great way to build a legacy. But at the same time, she has $95,000 she can immediately access from this, not pay a penalty on it because she's over 59 and a half. And the only tax liability for her for doing that will be she's going to have to pay taxes on the dividends while there's a loan outstanding.
So she puts in $100,000. I see her guaranteed cash value in the first year is $95,311. If she borrowed that in the first year, there wouldn't be any taxes, right? Because there hasn't been a dividend yet.
There wouldn't be taxes on the loan, but when the dividend is paid at the end of the year, if that loan has not been repaid completely, she's going to pay taxes on the dividend.
Okay, so let's say that she took out a loan in the second year instead. So the cash value would be up to, it looks like about 99,000, let's say, not 90.
Still no taxes because it's not more than what she paid for the premium of 100,000. When the cash value gets above the premium, so in year 3 here, when there's cash value of over $100,000, when she takes a loan, the IRS says, you got to take the growth first because we want our taxes on it.
Okay. So a little part of that loan would be taxable at that point. But and that's going to be taxed at the time the loan is taken. When the loan is paid back, that increases the tax-free base at that point.
That's right. And once the loan is repaid, then the taxes on the dividends stop.
Okay.
If you take another loan, then
you're paying taxes on the new dividends
yes,
that come in since then. Okay.
And Sherry is 63 years old, so the single premium policy for her is great. It buys a one-time death benefit. She never has to pay a premium again. She still has access to cash value. She understands that there are some tax implications when she takes loans, and she is fine with that. It works for her financial situation.
And her cash value is guaranteed to grow by $2,400 and more every year after that.
I'm looking at this here on this policy for Sherry. She puts in $100,000. That's the only premium she ever puts into this policy. Her guaranteed cash value is over $100,000 by year 3. That doesn't often, it usually takes cash value a lot longer to equal the total premiums paid because you're putting it in over time. For example, on the policy we just looked at on Ray, that was a good policy where he put in $100,000 every year for 10 years. His cash value is over $1 million in year 10. That's a good policy design. That's we'll typically see that somewhere between year 8 and 15 on a good policy. It can depend on age and health, but this is year 3 for Sherry.
And of course, the reason is that a single premium policy is just buying paid up insurance. It's not buying any base insurance. It's all buying paid up insurance. So that's why there can be a single premium. You buy this lump sum of death benefit and you never pay a premium again. It'd be like paying cash for a car or cash for a house. You don't have any more payments. You own the whole thing.
So the trade-off for that then is in the death benefit, because Sherry puts $100,000 in the first year. She has a death benefit of like $191,000. Ray put $100,000 in the first year. He has a first year death benefit of $2.5 million, over $2.5 million.
Different design, different reason,
design.
different concept altogether, but it can work for infinite banking. We just have to understand the details.
So now, Tom, tell us about David. David came to us. He is a business owner. He was really wanting to save on his taxes, and he was interested in doing infinite banking. He had $500,000 that he was thinking of doing something with for a policy.
And as we got to talking with David, he was really focused on saving on taxes. And there's some options that are open on the table for him by buying annuities and life insurance through a 412(b)(3) plan that would defer taxes. We're looking into that. But primarily, what it came down to is he wanted to do what Nelson Nash taught him years ago, and he never did. He said he had met Nelson Nash years ago, gone to a seminar, got real excited about it, but never really started it. So as we got to talking, David's pulling in about $1.5 billion a year in his company every year. And he's got this $250,000 P&C insurance debt that he has to pay to insure his fleet of vehicles for his company. And so as we got to talking, it made sense. I thought of a friend of ours, Ricky Hurd, that ran a P&C insurance industry when he heard Nelson Nash. And he said, if I can get my clients to fund a life insurance policy, they can self-finance the premiums on their P&C insurance. And so if David puts $500,000 into a life insurance policy, he'll have $478,000 he can borrow against so that he can pay his P&C insurance with cash, with a policy loan. And then as he pays back the policy loan, he gets to deduct the interest that the insurance company is charging on that on his taxes personally. And he just pays taxes on a dividend of about $4,500, which is a whole lot less than the deduction he's going to earn by financing his P&C insurance. So again, this is a single premium policy. He paid $500,000 once, and he just keeps using that money over and over again. And just paying tax on a small dividend is a whole lot better than what he was facing earlier.
Yeah, I'm looking at this policy here. He starts out 65 years old here. He puts $500,000 in. By the 10th year, he has $592,000 guaranteed, almost $652,000 projected cash values. That's a pretty good deal. And his death benefit is doing really well too. He has like $907,000 of guaranteed death benefit, almost $1 million of non-guaranteed death benefit when we include the dividends. And something, even with a modified endowment contract, this death benefit, that's tax-free when it goes to his beneficiaries. So if something happens to him, the modified endowment contract only affects the taxes when he takes policy loans or withdrawals during his lifetime. When it goes to his beneficiaries, he gets all the tax-free results of that as far as the estate planning aspect goes.
So a single premium policy in a corporate situation can be a real tool for buy-sell, because a lot of time business partners are not the same age. And so it can be really expensive to buy insurance on an older partner.
Sure.
If we do it on an annual basis. But if we have a lump sum we can put in there and get a death benefit that's going to buy out the partner's shares, then we've got a buy-sell agreement going that can be funded very inexpensively.
That can be a great planning tool.
When we get back from the break, we're going to talk about another option. If you don't want a lump sum in a single premium policy, there is another option for a more traditional whole life insurance policy for infinite banking.
If infinite banking is a simple process, why does it seem so complicated? Could it be that infinite banking started out as something simple, but over time has morphed into a convoluted process of buying a policy to borrow from the policy so you can pay interest on your own money and still come out ahead? Could it be that some people selling infinite banking policies have made it seem exclusive just for the wealthy or financially savvy? Could it be that insurance terms such as modified endowment contract, 7-pay test, direct recognition, overfunding, and paid-up additions are hard to understand? We think the answer to all of these questions is yes. Infinite banking, as most people know it today, is too complicated and confusing, but it didn't used to be. That's why we've put together a binder called Infinite Banking Made Simple. It's just the essentials, no mind-bending magic or number gymnastics. Included in the binder are answers to the top commonly asked questions, like what is infinite banking, how does it work, and how much does it cost to start. We've made the binder available to you as a free digital download. Click the button to get your copy of the Infinite Banking Made Simple binder. You can also get a copy of this binder at mcpheeinsurance.com.
Over the years, we've had people come to us that have won the lottery, got a huge inheritance, or got a big settlement from an insurance claim. And they ask us, what can we do with this large sum of money without running afoul of the IRS? And when people are younger than 59 and a half, we don't even consider a single premium policy because of the tax ramifications. So there is another option, like you mentioned right before the break, Michelle.
A lump sum of money can be deposited with a life insurance company in a separate account, often called one company calls it a premium paid in advance account, where they lock in an interest rate. Your first premium is paid, and then they lock the rest of the money in a interest-bearing account that will pay your future premiums. And we've used this several times with different people. And one of the people we used it for was with Steve. And Steve came to us. He had $500,000 that he wanted to be paying premiums, and he was in his 50s.
He's not 59 and a half. We don't look at a single premium. We look at an insurance account that is separate from the insurance policy that bears interest. And when you fund that account, it locks in an interest rate for the entire time that that fund is going to be used to pay the premium on an insurance policy. So you design the insurance policy. The insurance company themselves has to design this policy because they're dealing with interest rates and they want to make sure it's done right. But in Steve's case, that $500,000 paid a $51,497 premium for 10 years.
So that ended up being more than $500,000. It ended up closer to like $514,000, $515,000 by the time we get through there.
And at the end of 10 years, he has $574,618 of cash value.
Okay.
So in that situation, Steve saw that this was a great place to park money that he really didn't need because it was a settlement. And he was able then to use this policy as a banking policy as the cash value grew. Now, a lot of people are worried that they're going to lock this money up in this account and they're not going to be able to access it.
And that's not true. So they can, if they need to use funds, they can access cash value in their policy just like usual. Or if they want, they can go to the insurance company and say, I want to access the money in this separate account. At that time, they release that money, all of it. They can have all the money back, but they are responsible for future premiums. If they want to use that account again for the policy, they have to wait at least a year. So it's not like you've locked up your money, you can't get to it. You've just changed how you access it.
Another option that Steve has is after 10 years, he can continue paying premiums on this policy, or he can decide that it's going to be completely paid up. And if it's going to be completely paid up, the $1.7 million of death benefit is going to be reduced down to the amount of insurance that has completely been paid for. There'll be no more premiums. Or he can reduce the premium from $51,497 to just the base premium and keep that $1.7 million and continue to see cash value grow. Either way, the cash value is going to grow. So lots of different options here. He can still use it for infinite banking. It's a great product for the right purposes.
And Tom, you mentioned that the insurance company designs these policy illustrations for us, but they do it for us because we keep going, we supervise that whole process because they'll send us an illustration. We'll say, nope, we don't like this because they haven't got the cash value high enough for us. So we keep sending it back to them. And I know I've worked with someone multiple times, having them redo illustrations until it's finally where we like it.
And the reason for that is we know what we're doing. The people designing these policies at the insurance company really don't know what our client needs are. And we have to steer them and guide them until we get the policy that exactly fits the needs of our client.
Now, this policy for Steve, this was when interest rates were lower. So
They were.
$500,000 turned into $514,000 to $515,000 of premium. With interest rates being higher, we can get more than that today.
The interest rates were lower, but the interest rates were higher than any place else he could park his money at the time. And so locking it in at that time was a really good deal for Steve.
We have another example of a grandfather where he wanted to give a lump sum of money to each of his grandchildren, and he wanted it to purchase a policy premium. Now, the grandfather didn't want to be paying it out every year. He just wanted to give one gift and be done with it. So we use a premium paid in advance account. That money was put into the account. It will pay the future premiums. It will do it for 10 years because the grandfather doesn't want the kids to have to pay to fund the policy any longer. So it will fund the policy for 10 years. It is a great gift to those grandkids.
The strategy that we're thinking about plays a role in this as well, because sometimes people will come to us with a lump sum and they want to put it into an infinite banking policy and then borrow it all back out to go make some sort of investment. Sometimes this is referred to like a 90-10 policy where people can do a big lump sum and then do a smaller premium after that. That's a little bit different than a single premium design. Usually when the policy is designed, people will add a term rider onto it to boost the death benefit up and avoid that MEC status, but you can still take a policy loan out of that. The issue with that is the policy doesn't grow as quickly as the loan interest on that entire lump sum of money because it's essentially a small policy, and now you just added a lot of interest when you're taking the loan out the entire time. Now, if you were going to start a 90-10 policy and leave all the money there for several years, then it works out better. But if you're taking it all out as a policy loan, that's why we don't typically like a 90-10 policy design. There's often a better way to strategically design that, using a smaller policy and getting the money into the policy over time.
I'm thinking of Don. Don just recently came into a lump sum of money, and so we designed a single premium policy for him for $300,000. But then we also used that special account at the insurance company for prepaying premiums for 10 years. And that interest rate now is over 5%.
Actually, no, it's 4 point something.
Oh, it's dropped to 4 point something. Okay, so right now that's going to lock it in at like 4.8 or something. And now Don gets to look at both of these policies and decide which one's going to fit him most. And of course, he's 63, so he's over 59 and a half. So maybe the single premium is going to work for him, but maybe he would like to see what the prepaid insurance account policy does for himself as well.
So let's see. If we look at the single premium, he puts $300,000 in, and he has $285,000 available to borrow right away. He has a death benefit of $530,000. Of course, Don's interested in the cash value, and he has more cash value than he has paid for the policy. It takes 4 years on Don. At 4 years, he has $306,922. There again, borrowing from the policy. If he borrows more than what he puts in, then that is taxable. And while he has a loan outstanding, the dividend is taxable.
So if we look at year 10, the single premium policy on Don has $387,000 of total cash value, whereas the prepaid insurance account only has $353,000. But the death benefit is much larger for the first 10 years in the prepaid insurance account.
Yeah, he does have quite a bit bigger death benefit. What is that? So for the single premium, he has a death benefit of around $535,000. For the premium paid in advance, he has a death benefit of about $900,300. What is the difference there?
It's the way the insurance company has to design that prepaid insurance account to take the cash out of the prepaid insurance account and pay the premiums on that policy in 10 years. So that prepaid insurance account policy is paid up in 10 years. And so after 10 years, that death benefit of over $1 million in year 10 is going to be reduced. And it's going to be reduced right to about what the single premium policy is going to be, right around $575,000.
Okay.
There are pros and cons to all life insurance policies, and we have to find out which one fits the needs first. Sometimes people are just looking for a steady stream of income for the rest of their life, and we might not even consider a life insurance policy in those cases. We might look to a guaranteed income life, a guaranteed annuity that's going to provide an income for the rest of their life at a certain pace or adjusted for inflation. We've used that with several people, and it works beautiful if it fits their needs.
That's right. Annuity provides a great income stream. It's not great if you need access to the money.
Immediately.
Right.
But if you need a steady income, an annuity can really fit the need. There are lots of different places where we can put a lump sum of money when we're considering infant banking or retirement needs or a steady source of income. But it's always important that you consult with us so that we can find out what your needs are and what your objectives are so that we can meet those and so that you're not disappointed.
At McPhee Insurance, we help you sort through the options so you can get the greatest value for your money.
Come back next week for our conversation about money and liberty and where our focus should be as we strive to be good stewards with the money God has entrusted to us. This will be next week right here on Wealth Talks.